you ready to get your mindset and finances ready for home ownership? I promise you by the end of this video, we are going to give you some major takeaways to start implementing today. My name is Andrea Kay, the realtor, and I'm here today with Larry McMillan, a lender from Ameris Bank. How are you doing today?
Fantastic. Thank you for having me.
Thank you for coming. So the date that this is being filmed is actually my realtorversary, a word I just made up. So I'm super excited to be here today. Thank you with Larry. And I decided to talk about things that I know that you can implement to start your journey to home ownership. We've both been in the business. I'm young in the business. I've been in the business about 2 years. Larry has been in the business for
27 years.
27 years. So we have experienced a lot of different things combined, and we want to just kind of break it down to small, minute things that you can start today. One of the biggest things, Larry, is credit scores, right? So it starts at the credit is what I tell my clients all the time, because that's what you need to kind of get in the door, right?
True, it is.
So
it is.
What is the credit score like? What do we have to do? Where we got to be at?
Well, in regards to credit scores, normally we usually like to see a credit score of at least 640.
Okay.
Now, if your credit score is below 640, does that mean that you can't get a mortgage loan? No, it doesn't mean that. However, it may limit you on what grant programs you can do. You may take on a higher interest rate. You may have to put more money down. But ideally, you do want to get your credit score to at least a 640.
Okay.
Yep. Now, with credit scores, you know, we all subscribe to the Credit Karma and the Credit Wise and the annualcreditreport.com. You know, we all subscribe to it. I get it. However, those are just your consumer credit scores. They're not your mortgage credit scores.
Okay.
So what you want to take a look at would be your mortgage credit score. And the only app that I'm familiar with, the only website that I'm familiar with that you can get that mortgage credit score is going to be MyFICO.
Okay, so, myfico.com.
Myfico.com.
Okay.
You can order your own mortgage credit score. It may cost you some money to actually do it, to get that mortgage credit score, but that's the credit score that we go off of. And we pull from all three credit reporting agencies.
Okay.
You know, we pull from Experian, Equifax, and also TransUnion.
Okay.
So we take that middle credit score.
Okay.
So your TransUnion may be 680, your Experian may be 660, and your Equifax may be 620. We're going to throw out the highest, throw out the lowest, and take that middle credit score of 660.
Okay, now what if it's two people together, a couple, friends, or whatever? How do you average the two, or is there some type of math behind that?
Right. So we won't average a score. We'll take the lesser of the two. So let's say the husband's credit score is a 640 and the wife's credit score is a 680. We're going to go by 640.
Okay, that's good to know. So myfico.com, because we want to get our mortgage credit score, because there is a difference between what we see day to day and what you guys see on your end.
That's correct.
Got it. And we're going to go with the lowest out of the three.
Right. Yeah. Well, we'll take the middle. Right. We're going to take
the middle.
Right. The middle credit score. And if it's two borrowers on the application, then we'll take the lower out of the two.
Okay. Okay. Got it. So you got your credit score. We know what we need to be for credit score. Now, the next thing that I know is very important as well is your debts. Like what kind of debts we have. I know for myself, I have student loans. I have, all these different things like a lot of other people. How do you guys weigh student loans? How do you look at debts as a whole as well?
Yeah, so student loans are definitely a hot topic in our business. How we calculate it. Let's say if your student loan is in a deferment status or forbearance status. So even though you're not making any payments on it, there's a formula, there's a calculation that we have to use when it comes to calculating your debt to income ratio.
Okay.
So what we do is that we take your outstanding balance of your student loan. Let's say you owe $50,000.
Okay.
The type of mortgage loan you're doing, let's say if you're doing an FHA mortgage loan, we're going to have to take half of 1% of whatever your existing balances.
Larry, how do we weigh student loans when we're looking at our debts and we're not paying them right now because they're in forbearance? So how do you guys look into that?
So with the mortgage companies, we have a certain formula, certain calculation of how we calculate your debt to income ratio when you have student loans.
Okay.
So let's say if it's in a forbearance status, in a deferment status, let's say you're currently in school and you're in an in-school deferment status, depending on the type of mortgage loan you're doing. So let's say if you're doing a FHA mortgage loan, we're going to take half of 1% of your outstanding balance and calculate that into your debt to income ratios.
Okay.
So let's say if your outstanding balance is $50,000,
Okay.
half of 1% of that is going to be $250. So even though you're not making payments on it today, when we calculate our debt to income ratios, we're going to use $250 as the monthly payment.
Okay.
Now, let's say if you're doing a conventional loan through Fannie Mae, I mean, that calculation is going to be 1% of whatever your outstanding balance is. So that'll be $500 using an example of 50,000.
Okay.
So a lot of times it's always good to get pre-qualified and pre-approved by your lender so that we can look at your total credit outlay, have your student loans, know what monthly payment we're using to calculate your debt to income ratios to let you know how much of a house that you can purchase.
Okay. Okay. So do you ever recommend that someone just go ahead and get on a payment plan beforehand, or do you really think it's best to just come to you, evaluate the situation, and then take it from there?
Yeah, definitely come to a loan officer so that we can let you know what the next steps are and what's the best way to get you the house that you like to afford. Sometimes what we'll do is that if you're in a deferment plan right now, and let's say you're in a forbearance and you're not making payments, we may recommend going to an income-based repayment plan.
Okay.
So, for example, let's say you owe $100,000 on a student loan. I mean, that's a big number. And then now we're calculating $500 a month onto your debt to income ratios. But if you go into your income-driven repayment plan, that income-based repayment plan, you may only have to pay $75 per month.
Okay.
So then we'll say, hey,
that brings down your debt.
That'll bring down your debt to income ratios. That'll help out with the qualifications. So we may recommend get into that income-driven repayment plan, get out of that deferment plan so that you can qualify for the house that you want.
Okay. Okay. So go to your loan officer, have these conversations. At the end of the day, when you're trying to purchase a house and you're getting your mindset and your finances right, like we talked about, you always want to consult with your loan officer because they are the ones at the end of the day giving you guys the money. And we want to make sure that any decision that you make, it still gets you to that end goal. So we talked about credit scores. We know where our credit scores need to be, 640 and up. We talked about debt as far as student loan goes and how to consider that, how loan officers consider that payment. Now, what about other debts? Now, you know we love to go shopping and we have the afterpays and all this fun stuff.
Yeah.
Even student loan refunds, since we were just talking about that. So what do you have to say to the people? What should we do about our shopping habits and credit cards and all that fun stuff?
Okay, and I get it. You know, we in 2025 right now. You have the afterplays, you have the uplifts. What's that? You have the Clariners, right? Clariners. Yeah, so I get it. Buy now, pay later. However, when we calculate your debt to income ratios, sometimes we have to include that debt in there as well too. All right, because we'll see the monthly payments coming out of your bank statement. So I guess every 2 weeks the money's going to come out. Underwriter 9 times out of 10 is going to ask about it. Hey, what is this debt? What is this going for? Now sometimes, let's say with Klarna, it's only for 2 months. We're not too worried about it.
Okay.
You will probably have to get us paperwork to show that it's going to be paid off in a couple of weeks. That's good.
Okay.
But however, I think with Uplift, I think they
can be longer term.
They could be longer terms. So we may have to include that into your debt to income ratios.
Okay.
And I think even like with Afterpay, they may charge you interest on these things too, which comes at a high rate. So we always recommend, if you're looking to purchase a house, stay away from the uplifts, the afterpays, the Clariners. Stay away from that. That just makes the process a lot simpler. And again, that'll help you with qualifying to buy a house if you stay away from those buy now, pay later apps.
Especially with the longer terms.
Definitely with the longer terms.
Okay.
Definitely.
Okay. That makes sense. Now, what about student loan refunds? I know that some people may still get them. I don't know if it's as common. I know back when I was in college, it was common. So can you use that money for down payments? Because oftentimes you're searching for like, how can I make this down payment, this lump sum of money? Is that something that?
Yes. One rule we do have is that the money that you need for your down payment and closing costs, it cannot be borrowed funds. Okay, you
Okay.
cannot basically take out a loan to get a loan.
Okay.
And
Okay.
so, if you think about it with the student loan refunds, you take out your student loan. Let's say your student loan is for $15,000. Your school only needs $9,000,
Hmm.
so you're getting a refund check for $6,000, and you're like, okay, Larry, here's my
Right. Like I
money
got
that I
some
have. I got some
money.
money. I'm
Let's
ready to buy a
go.
house,
Right.
and I get it. However, that $6,000 came from a student loan.
Right. So it's still borrowed money.
Still borrowed funds.
Okay.
Now, there are, just like with almost everything in life, there are exceptions to rules.
Mhm.
So when it comes to borrowed funds, now if you're borrowing against an asset, so let's say you're borrowing against your own 401k
Okay.
plan.
Right.
So
Right.
that's
Right.
your own money
Yes.
inside that account. You're actually borrowing against it. That's fine. But when it's borrowed money against something that's unsecured,
Okay.
there's no collateral, nothing attached to it, no 401k attached to it, like a student loan.
Okay.
Let's say you borrow money from your credit card. You do a cash advance from your
Yes, a
credit
cash
card.
advance. Okay.
Yeah.
That's considered borrowed money as well because it's a credit card. Okay.
And that's the part that's unacceptable.
Okay. So 401ks, that's an example of money that you can use. So that is your own money. But when it comes to credit cash advances or student loan refunds, something tied to an actual loan, because credit cards is a loan, your student loan is a loan. So
Right.
anything that's a real true loan is not something that you can really use, right?
That's correct.
Okay, well that is good to know. I definitely did not know that about the student loan refunds.
Yeah.
And I also didn't know about the afterpays because it's so frequently used that you're not really thinking like, oh, this is technically a bill,
Right.
a debt that
Right.
can go against you. So
Yeah.
that
and I
is
get
good
it.
to
I mean,
know.
and it's very convenient.
Yeah,
You
it
know,
is.
to go
And
into
it's
the
quick.
store quick. You could purchase something and get it now and just pay installment loans. But again, it's to a bank, to a mortgage company. When we look at it and we look at your bank statement, because nowadays bank statements are like the new credit report. It does show some patterns that you have. For example, if we see that your account constantly goes into the negative,
Mhm.
and let's say your rent payment today is $1,300, and then you're going to take on a new mortgage payment of $1,900, but your account is always in the negative, that extra $600
Oh.
per month, are you going to be able to manage that when your account's always in the negative? So the underwriting department, they look at your bank statements to make sure that you'll be able to make that additional $1,900, that additional payment
Okay.
on your mortgage, on your housing expense.
That's good to know.
So the underwriters will look to see, is there any uplift
Can you
accounts,
afford it? Mhm.
any afterpays, just that, can you afford this new mortgage payment?
Okay. Now, when you say the overdraft protections, is this when it has to be frequent, right? You're not talking about like a one-off
Right.
or maybe a two-off, but
right. Or even a 3-off,
yeah,
right?
But so
Yeah.
you're really looking at like consistently. This is always happening every other month or something like
Right.
that.
If
Okay.
you're habitual,
Okay.
keeping your accounts in the negative all the time, then
Yeah.
that sometimes that would need to be explained.
Okay.
Because sometimes there's errors that banks
Yeah,
make.
it could be something simple. Yeah.
And we understand that.
Okay.
But sometimes
It's a problem.
it's a problem.
Yeah. And buying a house is definitely a bill that is one that comes every month, so you want to be prepared. So we talked about credit scores, we talked about the different debts. Now I get this question often: how much money do I need to save for a house? Like how much money?
I know. Yeah. I mean, we always say definitely save as much as you can.
Yes.
Because there are expenses along the way. When you purchase a house, you need to put money down for your deposit. You need to pay for your inspections, for your appraisal. Usually the deposit on the house is going to be 1% of whatever the price of the house is. So you want to definitely have that money set aside. Appraisals can run anywhere from $500 to $600. Inspections can run
about $550, but depending on you're looking at as low as $300 if it's like a small condo. It could be as high as about $550.
Right. Yep. So if we're looking at a $300,000 house, what's that? $3,000 for the deposit, $600 for the appraisal, another $500. So at least $4,000
just to get started.
Just to get started. And we could certainly take a look at different types of grant programs that the county has to offer, the city has to offer, or the state has to offer. We could look at those programs to help out. But however, we will need some money to get the process
Yeah,
started.
because even with the grant programs, and we can talk about that next, you still have to have. I know some grants require like $1,000 of your own money or something like that. So with the grants, do you still have to have money? And also a big question I get is, how do I know which grants I qualify for?
Right. Yeah. So with the grant programs, you do need to have some money. Just like you mentioned, um, they mentioned you need at least $1,000 to get started. Some grant programs you need a little bit more, but at least $1,000 to get started. Now, in terms of which grant programs you qualify for, um, it'll be based upon your income. It's also based
Okay.
upon your household size. It's also depend upon area and location. The county has certain programs. Baltimore City has certain programs. The state of Maryland has their own programs as well too.
Mm-hmm.
Some local areas, for example, Bel Air Edison has a particular grant program. I know Garwin Oaks area used to have a particular grant program as
Okay.
well too.
Okay.
So you would always have to take a first-time homebuyers class to get qualified for the grant programs,
Okay.
and those counseling agencies can help you out to determine which programs then you may qualify for.
Okay.
Now, I could also help you out with that too because I do work a lot with the local agencies. So we'll point you in the right direction of where to go to get some
To
of the
get the
money to help
money.
you out.
Okay, so what if you're unsure as to where you want to live? So, like you mentioned, there's a lot of different programs in different counties. So what if I don't know if I want to live in a city? I don't know if I want to live in a county.
Mhm.
So do you how do I narrow that down? What's your recommendations to that when you're trying to get the grant funds?
Yeah, so in order to get the grant programs, you do have to take a first-time homebuyers class.
Mhm.
Now, normally, I'll send you to a counseling agency that handles both the city and the county.
Okay,
So there are a handful of agencies that
can do both.
can do both,
Okay,
almost like one-stop shop.
okay.
You go there, you take the class, and if you find a house in the city, you're okay. Or if you find a house in the county, you'll
You're
still
okay
be
with that
okay.
too.
Hmm.
Okay.
Yeah.
So that's good to know. So first time home buyers course, you take that, you go to the counseling session that they offer, which is
Right.
a requirement, and then you get that certificate. Once you get that first time home buyers certificate, you will then bring it back to your loan officer and proceed with the process and require to get the funds and all those things. So it's really nothing for the buyer to do at that point, more so as far as when it comes to finding the grants. It's really just reaching out, taking the course, and then they will let you know what you qualify for.
Exactly, exactly. And then also too, I mean, there's a difference between being eligible for the grant programs and then the grant programs being available. All right.
Oh, yeah.
Yeah. So, for example, in Baltimore City, right now as we speak, they do have the Baltimore City Employee Grant Program, where if
Okay.
you're a City of Baltimore employee and you're purchasing in the city, you could receive up to $5,000.
Yes, the live where you work, I think
Right,
it's called.
similar to the living
Okay.
and your work, exactly.
Okay.
But right now, with that Baltimore City Employee Grant Program, the funds are not available. So
Mm.
you may be eligible for it, but then the funds are not available. So if you're looking to purchase a house, and if the funds are available to purchase a house,
Mm-hmm.
use it.
Right.
Because instead of maybe saying, "Well, I'm gonna wait till the price of houses go down," or "I'm gonna wait until interest rates go down," the grant programs may not be available at that
At that
time.
time,
So
yeah.
if you're eligible for it and the grant programs are available, use it.
Okay, that's good advice. That's good advice. And I often tell my clients, home ownership is really about when you are ready. So if you are ready, like Larry just mentioned, you don't want to wait because you think something's going to happen. We don't have crystal balls. We don't know, oh, it's going to be a new program. It's going to be more money or whatever the case may be. If you have an opportunity, if you are financially able, if your mindset is ready, then go ahead and make that move because the best time is whatever time is best for you. So we want to make sure that you understand that. And so let's just do a quick recap because I told you guys we're going to leave you with some takeaways of things you can implement today. So if you are ready to purchase a home, number one, we want that 640 credit score. We want to at least have a 640 credit score. If you are unsure where you stand, we want you to look at FICO.com as a reference. This is not a paid ad for FICO, but it is a reference that you can take a look at because there are different types of credit scores that loan officers, automobiles, and any type of person lending you money look at. And FICO does a good job at kind of breaking it down as to what a loan officer will see. So we want you to do that, number one. Number two, we want you to also look at your debts as a whole. So kind of see what you have going on as far as any type of loans that you have going out. If you have student loans, we want you to talk to your loan officer. Make sure that you talk to them and say, look, this is what we got. And the only way you can do this is to get pre-approved. We forgot to mention that. So the only way a loan officer can tell you about your situation when you stand is if you get pre-approved. I know you probably get that question often, just talking about the situation, but you really won't know until you know.
Correct. Yeah, we like to take a look at your credit report, and a lot of times we can do a soft pull credit, so it won't be a hard inquiry.
Okay.
We like to go ahead and take a look at your financial documents, like your W-2s and your pay stubs and your bank statements, so that we can analyze everything and get you
And give you an
pre-approved.
exact answer for you. Because what happened to your cousin might not work for you.
Correct,
Okay?
right. Everyone's situation is different.
Everyone is different.
Mhm.
So it's very important that we do that soft pull. We as in the loan officer will do that soft pull to see exactly where you stand. So we got your credit score at 640. We got your debts under control or viewed via the pre-approval. And then we also have your money that you're saving up. So we know that you at least have to have money for your EMD and certain other things, which I will make a separate video breaking down exactly those funds that you need out of pocket. But whatever your purchase price is, you are going to at least have, let's just say about 3% or so that you want to have in hand, in cash in the bank, that you want to be prepared for. And you want to hope that there's grants available that you can use. And the way that you find that out is by getting pre-approved, talking to your loan officer, and then going to your first time home buyers course where they will tell you everything about home buying process, where they will also have a counseling session with you, looking over your finances and your budget. And then they will tell you that these are the programs that are out that are funded, that still has funds available. And of course, they will work with your loan officer and will make sure that you get you those funds if you qualify for it. So you have to qualify for it, and it has to be available. And then lastly, but not least, we're going to get you to your home ownership. We're going to get you those keys. We're going to make sure that you understand the process along the way. So it's a lot of different steps, but those are your major takeaways: your credit, your funds, and your mindset. We just want to make sure that you are ready for this. If you have any questions at all, if you're looking for a loan officer, if you're looking for a realtor, we are here to help you. We are here to advise you and lead you along that path to home ownership. We look forward to working with you.